Hey guys, Dan Jerseth here. I'm going to be going over, well, that's really bright. I'm going to be going over our investment calculator today. This is a beta version of something our team has put together in order to help you calculate ROI, rate of return on your cash on buying investment real estate. So a couple different things we have in this is property investment calculator, a net worth tracker. Super excited to look into this. And then also contact info and resources for you. For example, book recommendations for investors, podcast recommendations, videos, our lenders that we like to refer out. They're great to work with. Financial planner, home inspectors, everything you could possibly need if you're getting into real estate or building wealth in general. This is hopefully a good tool for you guys to use. So I'm going to first do a investment property in this investment property calculator. I'm actually going to run the numbers on my first duplex that I bought back in 2018, just so you guys can see how I would run the numbers on one of my properties, and you can do the same to yours. So I'm going to hop in here, and hopefully this is helpful. If you guys have any questions, make sure to reach out to me or somebody from the team, and we'll get you help. So the whole point of this property calculator is really so you understand your ROI. There's not really necessarily a right or wrong ROI that somebody is supposed to be shooting for, but obviously you want to be making cash. You want to be making more than what you're spending on owning a piece of real estate. The more money you make after all expenses, the better. Pretty simple, pretty self-explanatory, not too complicated. And this is what this calculator does. A lot of times newer investors that I work with, they're very confused and not really sure exactly how. And it's not very clear on what expenses to take out or to plan for. So for example, a maintenance problem. It might not pull up might not have maintenance issues for this whole 6 months, but you still should be putting a decent amount of cash aside for maintenance issues. We all know that houses need repairs sometimes. And for us, we put 5% of all of the revenue, all of our rents aside for any repairs that need to be done. And this calculator helps you figure out, okay, what is that number that we should just expect that's going to be plowed back into repairs? For example, okay, the paint looks terrible in the garage. Grounds maintenance, stuff like that, tree trimming, or maybe we need to put new gutters up there and they're broken, or whatever it might be, or the toilet's leaking and we need to hire a plumber. That would count under a maintenance or one of those cost things. So I'm going to hop right in here. Hopefully this is helpful for you guys. So I'm going to hop in and start with my first property, Woodward Avenue in Chippewa Falls. It was a duplex I bought in 2018 and one of my favorite properties. So market value, I bought it for $125,000. This is back in 2018, so prices are not going to reflect what the property is worth today or what it would sell for. This is just a example. So purchase price, don't worry about this. Just keep these numbers the same for now. Market value is 125. Purchase price is 125. So in this situation, I would put 20% down on this property. So I saved up a chunk of cash, wanted to do something with it. So in this situation, I put $25,000 down, and very simple numbers. I had $100,000 that was financed. So pretty simple, pretty self-explanatory so far. Purchase price, what your down payment is. If you don't know what your down payment is, reach out to either me, Catherine, Devin, somebody from the team, or reach out to one of the lenders on this back tab here for contact info and have a chat with one of them. Closing costs. So when you close, you're going to have title costs. You're going to have certain different fees for the services that are required for you to close in a house. So in this situation, I just figured 1% of the total purchase price towards closing costs. So about $1,200 for that expense. So at this point, we are, the down payment $25,000 plus the extra $1,200 for closing costs in. And then so interest rates at that time, I think they were like 4.5% when I bought this property. So I'm just going to put 4.5%. Again, go to Google or call me or your lender to figure out what your interest rates are at the time of putting this calculator or what you can lock it in at. And then last but not least, what is your length of years you can lock the mortgage at? So 20 or 25 is very typical for investment real estate. If it's your first few properties and you can buy it with conventional loan types, then you might be able to lock in a 30-year mortgage and span that whole mortgage out of a lot longer period, which is going to allow for you to cash flow more, but you're going to be paying more in interest. So it's all dependent on what you want, how to structure that. So your initial cash investment, like I said, is the $25,000 for my down payment that's required, plus the closing costs that the title company is going to charge me. So at this point, my initial cash to basically take ownership of this property is $26,250 that I'm going to bring a check to. So here you can see my monthly mortgage payment is about $555.83 per month. So that's important because that's going to be one of my largest expenses of owning a property is what I can lock in my low monthly mortgage payment at. And then you can also see over here on the annual rate, but we won't worry about that for now. So I bought this property. It was just a duplex. So you can see over here, if you're buying a fourplex or more units, you can kind of use this calculator as a helpful way to do it. Or let's say, for example, you're looking at an 8-unit and you don't have, obviously there's just one unit A, B, C, D. If you know there's 8 units and you know the rents are $5,000, it's cool. Just put $5,000 in this one. It's going to do the same exact thing as filling out all the cells separately for each unit. In this situation, it was a duplex. Each unit rented out for $750. So $750 unit A, $750 on unit B. So the total gross rental income, this is important, is $1,500. So this is my top of the line, what I'm working with. This is the amount of cash I'm bringing in on a monthly basis. That's what I am using to pay all of my expenses. So in this situation, I always figure in a vacancy rate, there might be 1 or 2 months. Maybe there's a month a year where your tenants are not, you're doing a turnover or you're painting the property and your tenants are moving out, and it's going to be a whole month of no rental income. So this number is actually figuring out how often that you're not going to have that property rented. So my new rental income on a monthly basis would be about $1,425. And now this is projecting things in the future that may happen. You always want to be thinking on offense rather than being defensive when a tenant moves out of your property, because that will happen at some point in time, just like maintenance repairs will happen. So 5% for vacancy. This is a very standard number, so you can use this 5% for vacancy. It's not really going to fluctuate too much. So use that 5%. And then down here, so what I'm going to do in here, if you guys have never utilized a Google Sheet calendar, and we might be able to just put this in here, but usually a property management company is going to charge you a percentage of total rents, not based on the new rental income. They're going to charge you on the total gross rental income. So my property management company charges me 7%, and that's a pretty standard number around here, at least. But obviously check around if you're in a different market than Eau Claire where I'm at. You might need to check what the standard is for rental management fees are. So in our area, it's about 7%. So what I'm going to do is, if you've never worked a Google Sheet before or worked a formula, is what it's called, all you have to do is press =, sum, SUM, and then this thing for a bracket, whatever you want. I don't know what that's called. And then click on the cell of gross rental income multiplied by 0.07%, and then another right-hand bracket, enter. And this is going to be 8% or 7% of my total gross revenue. And that's going to spit that number out there automatically for me. That way, if I change these numbers up above, that number automatically changes and I don't have to do a calculator every single time. Leasing costs, we're going to leave this one empty for now because my property management company actually includes their leasing costs in the management fees. Good deal, $105 a month to pay somebody else to onboard the phone calls about the leaky toilets and do new leasing. That's an expense that I definitely, now that I'm too busy to handle that kind of stuff, I'm more than happy to pay for it. When I first got started, I didn't have this property management fee, so I was managing it myself. However, you still want to calculate it because someday if you own 50 properties or 100 properties or even 10, 15, it does get to be a pain in the butt. And maybe you want to hire property management. So you always want to calculate as if you have a property manager in place, regardless of whether you're planning on using one or not, because you still need to get paid for doing that job. Maintenance reserve. What I want to do here is I want to do another 5% for this. So I'm just going to do equal sign, sum, bracket. We might be able to get this fixed so you don't have to manually do this by the time you get this, but times 0.05, which is, we want to calculate a 5% per month on any maintenance stuff that needs to be done. Painting, new garage door, new roof eventually. We always want to be making sure we're chipping away, putting money aside for that specific repair. So property taxes on this one, it was about $1,500 a year. So what would that, so $1,500, I'm gonna do the math with my calculator here. $1,500 a year divided by 12 is $125 per month, approximately. So this whole thing is very important for you guys to think about: property management, maintenance, your vacancy rate, your property taxes, and your mortgage. These are what is that? That's property management, maintenance, your taxes, your mortgage. That's 4 things that you need to be thinking about every single time, and your total revenue, what your potential rents are in that property. So these are 5 data points that you need to know on every single investment property that you buy. And it'll very much keep you out of trouble. You don't want to buy a property where you're not cash flowing and you're literally paying to own a property. That would be the worst situation to be in, unless you have some aggressive plan to raise the rents over time, or you're very, very confident that rents are going to be higher in the future than they are today. But that is a risky business to be in. Another thing is insurance. So for this property, for me, it's $100 a month. But about $1,200 a year for insurance. For me, my tenants take care of trash. So at this point, I can calculate my total expenses. Even though this isn't the dollar amount going out of my bank account every month, this is my total expenses that it's going to be over time that I own this property. So down here, net operating income at this point. So we originally are collecting. So this is where the annual gets important, because we're doing most of the things on a monthly basis, but then we want to look at the total year. So total year, we are collecting $17,100 from this investment property. After all of our annual expenses, we get our total expenses of $4,860. So once you take out the monthly mortgage payment or the annual mortgage payments and the total operating expenses of this business, you are walking away with, here it is, revenue. What's the revenue? 18,000. Yes. Sorry. Yes. So 18,000. My bad. I was getting a little bit confused there. So your cash flow analysis. So we're basically taking the total revenue minus your expenses, minus your mortgage payments, and you're going to figure out what your net cash flow is at the end of the day. So in this situation, we already calculated our annual gross rental income is $18,000. After we're taking out all the expenses, which is $4,860, and our mortgage payment for the year, we are actually walking away with $6,470. So now we can figure out down here what our actual ROI is. And let's see here. So year one ROI. So our cash on cash return and year one is actually 24%. And that's a really, really, really strong number. And this happened to be my first property. So I was very happy about that. I actually bought it on the market. It was on the MLS listed, and nobody bought it. It was on the market for like 6 months. Nobody bought this property. I had to go in there and do a few repairs to it and to kind of make it look a little bit nicer, but I got it rented out. And when I bought it, I knew it was a good investment property because I'd done this calculation already. So my cash on cash return on year one was 24. And that's going to continue to grow over the years, especially with appreciation and rental rates going up over the years. That just gets better and better. Now, obviously, property taxes go up, operating expenses go up. The cost for me to actually do have management company goes up as my revenue goes up. So there, obviously this number should get better. The longer I own it, the more equity I'll own the property. So there's a lot of benefits of, calculating this and just poking through these numbers and all this fun stuff. So I basically had $26,000 invested into this property, and I got out $6,470 on year one, and then continuing to get that amount of cash year over year over year. Really good property. Happy about this one. So hopefully this helped you guys. And I'm going to also go into net worth tracker. So if you hop over the net worth tracker cell, there should be another video about explaining how to use that too. So hopefully this is helpful for you guys. Peace out.